It's a setup every trader eventually faces. You identify a clear buy signal, enter the position, and watch as the price immediately begins to drift, indicator itself, assuming the settings were wrong or the signal was fake. But in most cases, the signal was technically accurate. The failure was entering a market that lacked the structural strength to move in any direction at all. To address this, we have to look back to 1978. That's when J. Wells Wilder introduced the Average Directional Index, or ADX, to help traders distinguish between a drifting market and a true trend. However, a common misunderstanding persists. Many traders see an ADX line sloping upward and conclude that the price of the asset must be rising as well. This chart demonstrates why that logic fails. While the price is clearly crashing, the ADX line was rising. The ADX is non-directional. It functions like a speedometer. It measures the intensity of the movement, regardless of whether the market is climbing or falling. When you confuse trend strength with trend direction, you risk applying trend-following strategies to a market that is fundamentally incapable of sustaining them. This slide outlines the ADX's 0 to 100 scale. Readings below 20 indicate a weak trend, where the market is effectively dead. Once the ADX enters the 20 to 40 range, a trend is actively building the momentum required for technical signals to become reliable. However, readings that push past 40 and approach 60 are rare. At these levels, the trend is often overextended and susceptible to a sharp reversal as the momentum finally exhausts itself. If you attempt to use trend-following tools while the ADX is below that 20-level threshold, you are operating in an environment that lacks directional conviction. The probability of a successful breakout drops significantly because there is no momentum to carry the price forward. To understand how these numbers are generated, we have to look at the two components driving the ADX, the positive directional indicator, or plus DI, and the negative directional indicator, or minus DI. In a traditional setup, a buy signal occurs when the plus DI line crosses above the minus DI line, suggesting that upward pressure is overtaking downward pressure. But look what happens when we zoom out. During that crossover, the main ADX line was flatlining below 20. This is the mechanical cause of the whipsaw. The indicator signaled a change in direction, but the ADX confirmed there was no strength. This is why professional practitioners use the ADX as a go-no-go filter. It dictates which specific indicators you are permitted to use based on the current market regime. If the ADX is under 20, you ignore trend signals and deploy mean reversion tools like the RSI to trade the range. Only when the ADX breaks above 20 do you switch to trend-following tools, like the MACD, to capture the momentum. The indicators themselves aren't failing. Rather, the trader fails by deploying the wrong logic for the current market environment. While the core math remains the same, the environment has changed. Today's markets are dominated by high-frequency algorithms and deep learning models that move faster than any human trader could in 1978. Recent empirical research has shown that feeding raw trend indicators into modern neural networks often degrades their performance. The simplicity of these traditional rules can struggle against the complexity of modern price discovery. A major factor is high-frequency trading, which generates massive amounts of noise on a minute-by-minute basis. These are rapid price fluctuations that don't represent a real change in trend, but can easily trick an indicator. This creates a trap for anyone trying to scalp on 1-minute or 5-minute charts. At that speed, the ADX often generates unreliable signals because it's measuring algorithmic noise rather than structural market participation. This comparison shows the evidence-based solution. While the 1-minute chart on the left is erratic, the daily chart on the right shows the ADX smoothing out. Its reliability increases significantly when applied to longer holding periods and slower moving averages. Institutional traders don't rely on the ADX as a standalone signal. Instead, they treat it as one feature in an ensemble of models, using it to confirm the regime before the algorithms execute. To survive in this environment, you have to move past the idea of a perfect buy signal. The value of the ADX lies in its ability to act as a mechanical filter, separating the actual trends from the noise of the machines.